Two respected strategists say metals are poised to climb even higher after taking a short breather now. Before we begin, remember to like this video and subscribe for more economic updates. From the end of February through the middle of May, gold increased 20% to more than $2,400 per ounce. Since that time, gold has given back a little momentum and been trading in the $2,300 to $2,400 per ounce range. In the assessment of Ole Hansen, head of commodity strategy at Saxo Bank, the precious metal sector is undergoing an extended period of consolidation. And following the strong run-up earlier this year, this phase gives traders and investors time to catch their breath while adapting to new and higher levels. Like numerous other analysts, Hansen dismisses the idea that the decision by China's central bank to pause gold buying is a lasting one, given the belief that gold's fundamental drivers remain intact. As Hansen puts it, China, a major driver of the gold rally since 2022, is, in our opinion, nowhere near done buying gold, and we believe the pause is mostly driven by the bank balking at the prospect of paying record prices. It's not only China's central bank that's expected to keep buying. According to the results of the World Gold Council's just released 2024 Central Bank Gold Reserve Survey, more than 4 in 5 respondents said they expect central bank gold reserves overall to increase over the next 12 months. According to Hansen, the principal drivers of gold price support include continued central bank demand amid geopolitical uncertainty and de-dollarization, and not least gold's ability to offer a level of security and stability that other assets may not provide. Another prominent expert who believes gold will move higher after consolidating is John LaForge, head of real estate asset strategy at Wells Fargo. LaForge suggested that a return to accommodative monetary policy by central banks around the world against a backdrop of high debt might prove to be supportive of gold. The U.S. national debt is approaching $35 trillion, while global debt recently topped a jaw-dropping $315 trillion. It's not just in the U.S. debt is piling up around the globe, which is why you see so many central banks turning to gold, LaForge said, adding, as long as debt is an issue, gold will remain an option on the table. Saxo Bank's Ole Hansen also sees debt as another prominent gold driver. Rising debt to GDP ratios among major economies, not least in the U.S., raising some concerns about the quality of debt. That's a particular concern among emerging market nations, where the overall debt to GDP ratio is now an eye-popping 260%. You know when you're in the eye of the storm, things get real quiet. Yet we still know what's coming ahead. Right now, it seems we are in the eye of the storm. There's a ton of geopolitical tensions and economic volatility. Nothing big has hit yet. However, we all feel something big is coming. And what are the central banks doing? What are the big money managers doing? They're buying gold. Why? Because it might be the shelter in the storm.